Taxes in retirement. If you can win that battle, it will go a long way in you winning retirement. What are a few things that you can do right now to minimize the taxes that you're going to pay in retirement? Got that more coming up. One of the biggest myths about retirement is the assumption that your taxes will automatically go down during your golden years, during retirement. And that's not necessarily the case. Not only is this sort of this conventional thinking and a myth, but it was even taught in textbooks. I've been a certified financial planner, been doing this for over 20 years now. And yeah, like in the early 2000s, it was basically in the textbook. It was taught that, yeah, taxes are going to go down in retirement. Therefore, you're going to want to coach people. It's going to make sense for them to contribute pre-tax to their retirement accounts while they're earning a lot of income. They need that deduction in retirement. They won't have as much income. They'll pay the tax then, and it will all work out. Now, the Roth IRA was very new. It wasn't very popular at that time. And for some people, when you can mathematically compute throughout sort of the planning process and that multi-year tax projection that, yeah, your taxes will be lower in retirement, fantastic. It certainly will be the case for some, but not for all. And there's a growing number of people that find themselves in the same tax bracket or even in a higher tax bracket in retirement. Things like paying taxes on their Social Security, required minimum distributions, potentially receiving an inheritance, all of these things can add up and potentially impact the taxes that you pay in retirement. But it doesn't need to be that way. You can actually, through proactive, wise tax planning strategies, there are things that you can do right now, either during your career, the late stages of your career, or in retirement. You can do some things right now to lower your tax bill in retirement. Likely what's going to be your largest expense throughout retirement, taxes, if you don't do proactive planning. Many people think it's healthcare. It likely is going to be taxes. What are some ways that you can, where you can not make that so, right? What are some creative tax planning strategies to reduce your taxes in retirement? Let's get into it. The first is to prioritize Roth contributions and Roth conversions. Whether it's during your career or even in the late stages of your career, make sure that you're making an intentional, proactive choice, whether it makes sense for you to contribute pre-tax or Roth. Again, if the name of the game is trying to have as much of your wealth growing tax-free for your future so that you can pay less taxes in retirement, I mean, the vehicle to use is the Roth. You're going to want to do the calculation, working with your CFP on an ongoing basis to see, does it make sense for you in this particular year, no matter, like, depending on your circumstances, what does it make sense to contribute pre-tax or does it make sense to do Roth? But be opportunistic and prioritize that Roth so that all of those decades of potential growth can be tax-free using the Roth. And then strategically add in Roth conversions, whether that's during your career, if you have an interruption in income, or if you see a sudden drop in income or drop in taxes, maybe you're eligible to, you're going to itemize your taxes maybe for the first time in a long time because of the new SALT cap. And that's only around for the next 4 years. So maybe you want to do some Roth conversions during that time. Or early in retirement, doing Roth conversions strategically to shift dollars from pre-tax, paying the tax on those dollars, shifting them from pre-tax over to the Roth, whether Roth IRA or the Roth side of your 401k, so that they can then grow tax-free for the rest of retirement, for the next several decades. This alone has the potential to save thousands, if not tens of thousands of dollars of tax for you and potentially your heirs. For you, having more dollars in the Roth can improve the amount of your Social Security that you pay tax on, could improve the impact of your required minimum distributions and what tax bracket that pushes you in. It could improve the income-related monthly adjustment amount, or IRMA, what you could pay for health insurance. And if you happen to retire before Medicare, it could help you earn or receive some premium tax credits, advanced premium tax credits. So advantage Roth. Prioritize the Roth. That is the number one way to reduce your taxes in retirement. Second, make sure you have an intentional withdrawal strategy when you do get to retirement, turn on Social Security, and are starting to withdraw from your portfolio to supplement your Social Security. Make sure you have an intentional withdrawal strategy. What do I mean by that? Well, if you reach retirement and have tax diversification, meaning you've got a chunk of dollars growing pre-tax, where as you withdraw dollars, it's going to be taxable at ordinary income rates. You've got a chunk of dollars that hopefully are in the Roth, and then maybe you have some additional dollars that are not in a tax sheltered. Either these are extra dollars in cash reserves that you've built up, maybe a non-IRA, non-qualified account, which would be an individual account, joint account, a trust account, revocable living trust account, something like that, where it's growing, where there could be capital gains and dividends. It's not tax sheltered. If you've got that level of tax diversification, you've got to make sure that you have an intentional withdrawal strategy. Which dollars do you pull from first? Which accounts do you pull from first? It may make sense and could make the difference of thousands of dollars of tax if you say, well, I'm going to set up a withdrawal strategy from my pre-tax account up until the top of this tax bracket. Above and beyond that, then we're going to pull from our cash reserves, or then we're going to pull from the Roth. If you build out that intentional strategy and are opportunistic, that again has the ability to significantly improve your tax picture in retirement. Third, leverage charitable giving wisely. In retirement, there is an opportunity, a new opportunity that doesn't exist during your working career for you to give dollars, donate dollars to the church or to 501c3 charities in a more tax efficient way than you can otherwise do. During your career or before this time, leveraging things like a donor advised fund or bunching up charitable contributions so you can optimize your standard deduction, that can go a long way as well. But specifically, the qualified charitable distribution, the QCD, you're not eligible until age 70 and a half. And at that point, you could donate dollars, transferring them directly from your IRA directly to the charity. In doing so, dollars are coming out of your IRA, but they're not being taxable. If they go to you, because you're supplementing your Social Security, your cash flow, and then on a weekly basis or monthly basis, you're donating dollars just out of your checking account to charity, you're having to pay tax, you're having to claim the dollars that came out of your IRA as income on your return, and then you have a chance at claiming the deduction by that donation to charity. But oftentimes, it's not a wash. It's not a one-for-one deduction. And most states, if you're in a state that has state taxes, most states don't give you a charitable deduction. However, doing the qualified charitable distribution where dollars are going directly from your IRA directly to the charity, there is no taxation of those dollars. The dollars come out of your IRA, they're not taxable to you. They don't need to land on your return and then hopefully you get a charitable deduction. It's just not taxable. So it helps you in that calculation for whether your Social Security is taxable, helps you with IRMA, helps you with state taxes, lots of benefits. Qualified charitable distribution. It even can count towards satisfying your required minimum distribution. So taking advantage of that, that's the third way you can minimize your taxes in retirement. And then lastly, awareness and management of state and property taxes. Now, this one isn't for everyone, and it would require some significant lifestyle adjustments. Very rarely would people say, you know what, I am intentionally going to retire to a state that doesn't have state taxes. However, it is something, if you think that you are going to move in retirement, potentially to be closer to grandkids or closer to warmer weather, something like that, being aware of those states' income taxes can really help you go a long way. If you're looking at one certain region and one state doesn't have state taxes, state income taxes, but the other one does, that may influence, well, where exactly do you land? The other is just being aware of which states have a deduction for pensions or retirement withdrawals in retirement. Many states, so right here, I live in Indiana, but we're very, very close. I could almost hit a golf ball from my house to Michigan, where I'm that close. Well, Michigan actually has a deduction where you get to deduct your pension or IRA withdrawals as well as not tax Social Security. That's how the state taxes work in Michigan. In Indiana, they don't tax your Social Security, but all of your retirement benefits, pensions, and IRA withdrawals, those are taxable. You want to be aware of that. Again, not that you're going to uproot and you're going to move from one state to another just for taxes, but you do want to be aware of it. And same with property taxes. Oftentimes in retirement, you're going to move, whether that's early in retirement, okay, the kids are out of the house, we're ready to move to something that's all on one level, less maintenance, something like that. You want to be aware of what the property taxes are because statistically, other than taxes, it is stated that your housing expenses are categorically going to be the highest, the number one expense you have in retirement, healthcare being after that. Most people think it's healthcare. I think it's going to be taxes, but outside of taxes, the statistics actually say housing expenses. And so property taxes would be part of that. Making a wise choice on which house to live in retirement, where to live, has a significant impact on the property taxes and your longevity of your resources during retirement. So those are 4 ideas that you can implement, you can work through with your certified financial planner. There's a long list of others, so make sure that you're working with a CFP that's doing proactive tax planning to help you lower the taxes that you pay in retirement. If you don't have a CFP on your team, you can contact one of my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. Right there you have it. Go out and take your next wise step in your financial life.